So I don't know if any of you have got children. Mine are fairly young, they're 9 and 10. And recently I bought them a phone because they live up north, I live down south. I bought them a phone with a cheap SIM card with only the ability to text message me so we can stay in contact. What do they do, as children do, is they lost it, right? Over the last few weeks, been looking for it everywhere. They say they've been looking in their house up north, ripping it to shreds, trying to find this phone, and they can't find it anywhere. They can't find it anywhere, right? And if you have kids, you probably know what it's like when they lose things. Anyway, today, I got a text message from them this morning saying, "Oh, Dad, we found the phones, fantastic. We can communicate again." I'm like, "Where was it? Where was it?" And they're like, "Look, it was just in our bedside table drawer under some cards." And the reason I'm telling you this story is it made me think that it doesn't matter where you're looking. If you're looking in the wrong place, you're never going to find the true answers. Or indeed, if you're not looking for the right thing and you don't want to see the right thing, then you're not going to actually see it, right? And something I want to talk about today is cognitive bias, which is effectively our internalization of our belief system and making a choice or a decision or creating a belief that's not based on actual facts, figures, and data. It's based on our internalized beliefs, okay, or things that confirm our beliefs. So we've got different types of cognitive bias. And I feel we're seeing this at the moment in the property market. Because let me just come off this. When I come onto social media, go onto Facebook, go onto YouTube, I see a lot of people still talking about the fact that house prices won't go down because of the laws of supply and demand. And we're in Ireland and we've got, so many less properties than people, net migration, there's 1 million people a year and all that sort of stuff. And so therefore, property prices are always going to go up. And I'm not saying in the long term, macroeconomically, they won't. But for me, that is a cognitive bias that we are taking that data set, right, and creating a reality around it. And what I want to be doing is looking at the real data sets or looking at all of the data sets. So, left of arc, right of arc, to understand what's actually going on and try and remove that subjective cognitive bias so we can actually make informed decisions based on what we're actually seeing rather than our subjective decisions based on our internalized belief systems. So that's what I want to talk about today. So first of all, good evening, everybody. It is Monday evening. We are live, so if you can hear me or see me, please give me a thumbs up, put something in the comments. Tourism Golf, hello. Sorry, I was a bit of red herring to minus 35%. I don't actually think we're going to get to 35% tourism. We'll talk about, where we could go in the range later on. For those of you who are new to the channel, welcome, big welcome to the channel. On these live streams, my aim is to look at the data, crunch the numbers, so we can make informed decisions, better decisions about investing, where we put our money, as we take back control, our own financial freedom and legacy from those who are trying to take it away from us. Okay, so today I'm going to talk about an interesting concept that I've been thinking about, and I've been trying to understand where the market is at the moment. It's obvious that we are in paralysis in the property market. A lot of people and a lot of commentators are talking about actually we've got massive resilience in the property markets. We're not seeing the huge price falls in 2023 that many commentators, were thinking. And when we talk about price falls, we are talking about nominal price falls. We'll talk about real house prices in a bit. But I want to look into 2024 and about what might be happening. Now, last week I did a prediction on 2024, and I went through 5 scenarios. And actually, somebody put in a 6th scenario, which was, quite an extreme one. And I'm kind of going to focus a little bit on that because there is, I'd say a fairly decent probability that scenario 6 might actually come into play as well. But first of all, I want to talk about why debt is actually an asset or has become an asset. And when I talk about debt, I'm talking about cheap fixed rate debt, okay? And to delve into this, I want to look at this graph, which the light blue line is interest rates, the sort of purpley line is the house prices, and I want to draw your attention to financial crisis of 2008 and where we are now, okay? And this is hopefully going to start to explain why the market dynamics are as they are at the moment and gives us a forward-looking projection into next year to see what's going to happen. So you can see there's one clear huge difference between 2008 and now. And that's the fact that in 2008, interest rates, I'm not going to say they were high, but they were higher than we've had for the last 15 years. If you look at sort of historically, they're actually low. But we have to get away from talking about are historically interest rates high or low, because of course, Yes, here interest rates are low, but property prices have gone up hugely in terms of price to earnings ratio and the amount of debt people have taken. Okay, interest rates were probably, in terms of affordability, pretty high. But anyway, interest rates were much higher. Financial crash came, and all of a sudden, interest rates went from 5.25%, 5.5% down to 0.25%. In fact, Q1 2008, interest rates are exactly where they are now. So we saw a massive change in monetary policy. Interest rates went down to 0.25, and we went into quantitative easing. Now, okay, let's fast forward to 15 years to basically where we are now, and we're seeing completely the opposite. So we're seeing interest rates going up rapidly. Yes, they're now paused, but at 5.25%. And rather than quantitative easing, we're in a tightening cycle of quantitative tightening. So we're in a completely different macroeconomic or monetary cycle. Now, what does this mean? So when we're over here in 2008, because there's a lot of people on fixed rate debt, which is going to be 5, 6, 7% mortgages, okay, and we hit the financial crisis and the house prices start tumbling down, and the banks, because of course the financial crisis was caused by the credit crunch, lack of being able to lend, the banks are now starting to look at repossessing property. Another thing to mention actually is we have some artificial stimulus right now, and I think this is starting to play a factor. That, you know, the banks have entered this sort of agreement, or the lenders have entered this agreement with the government not to start repossession proceedings for 12 months after when they would do normally. So we've got some artificial sort of manipulation, if you like, of the market that's helping prop things up right now. Anyway, people are on higher interest rate products. You go into negative equity. The banks are starting to get, starting to come knocking on the door. And actually, because interest rates come down, you can just give the keys back to the bank, allow them to repossess, and then you can move into either rental or, sort of get much smaller mortgages on cheaper interest rates, which is, of course, why we then have, and if I zoom in here, the market comes down, hits a base, doesn't start going up again, but having those interest rates cut massively cushions, and effectively saves the market from going to where it could have done. Now we're in a completely different situation, okay? We own people with fixed rate debt, very cheap fixed rate debt. And of course, if property prices are coming down, let's say people are now in negative equity, and logic goes, property prices coming down, interest rates going up, people in negative equity, there's going to be more for sellers. But we've still got a lot of people on that cheap fixed rate debt. And if you do not have to liquidate, if you do not have to sell, why would you get rid of that cheap fixed rate debt, which right now is an asset? Okay, it's very, we talk about good debt, we talk about bad debt. But why would you get rid of it if you don't have to? And also because the banks aren't repossessing, you can sit on that cheap fixed rate debt. Whereas if you get rid of that cheap fixed rate debt, right, you're going to go into a much higher mortgage rate product, even regardless of what's going with swap rates and bank mortgage rates right now. Or you're going to go into rental, and rental, of course, is spiking off the chart. Right, people don't want to go into rental because it's very expensive and there's a massive lack of supply. Okay, so because of that, for me is why the market is completely paralyzed right now. It's not because of a supply demand thing. It's because there's a lot of people with cheap fixed rate debt, which is right now effectively an asset for them. However, this is starting to unravel very quickly now. And this is why I think there is a scenario where 2024 could get quite messy for the property market. I'd love to hear your thoughts on it, by the way. As we're going through this, I'd love to hear what you think is going to happen in 2024. So please put it in the comments, whether you're on the live or you're watching it on the replay. I'd love to know your thoughts in a sort of range of where we're going to be going from, let's say now until the end of 2024. Because as this asset disappears, and it's disappearing now very quick, we could see more sellers come into the market. Compare this to America's different in terms of mortgage investment. The majority of mortgages in the US are fixed for 30 years. So over the cheap debt, people who have fixed in over the last, not the last 18 months, but in the previous period, who've fixed in for a long period of time, are sitting on that huge asset. Don't have to move, right? Props the market up. In the UK, we've still got a lot of people sitting on that asset, cheap rate debt. But in the UK, it's going to be going, right? Over the next couple of years, we're going to be losing an awful lot of that. Now, why does this make such a difference in the first place? Well, let's just see what we can do in terms of affordability. Let's say all the other factors are remaining equal. So you're on the same salary, there's no inflation, any of that sort of stuff. It's just what can you afford to borrow as you go from, and this particular graph is just showing 2.5% to 5% interest rate. And you can see here with the doubling of interest rates, how much less you can borrow to go and buy a house. And ultimately, people do not pay what a house is worth They pay what they can borrow, which is why when people have access to huge amounts of pretty much free money, government-backed mortgages, Help to Buy, all of that sort of stuff, where the government is taking on all the risk, potentially for longer terms, whatever other stimulus you've got going in, stamp duty, all that sort of stuff. When there's stamp duty holidays, that's going to be stimulus, massive stimulus. People can borrow more because effectively they're saving that stamp duty that's not going in, or that would have been taken away from the deposit. Now they're not paying the stamp duty, goes into the deposit, means they can sort of afford even more. It's nothing to do with value. It's all to do with what you can afford. So of course, the moment we go from cheap to expensive rate debt, what we can afford actually comes low. So again, theoretically, if everything else stays equal, interest rates go up, house prices have to come down because people can afford less. Now, yes, we do have higher nominal wage growth, but that's still been, for the last 18 months, below inflation. So in real terms, right, our wage growth has been, or our wages have been eroding. Only now are they real time, more than inflation. We'll have to see what happens with that. And of course, that nominal wage growth has affected what people can borrow. But leverage works both ways. Leverage works when you're buying, or when property is going up, it multiplies. When it comes down, it's also sort of compressing your equity in there. So this is why it's so important. Now, let's see, because of where we are right now, with people who are hanging on to that cheap fixed rate debt, we can see just how little we have in terms of property transactions. I mean, and this is old data now, right? This is from the last UK ONS HPI, House Price Index. So this is July 2023. What are we? We're November, right? About to go into December. So I'll be interested to see sort of transaction volumes now. Of course, this is the problem using UK ONS. They're so many months behind. It's a rear view mirror that's not particularly helpful for us. But you can see how much we have contracted in terms of sale volumes. It's just proving that we are in paralysis, not resilience, right? I do not believe we're seeing a resilient housing market. I believe we're seeing a paralyzed housing market because we have people who do not want to get rid of the asset, which is their cheap fixed rate debt. And they're not being forced to do so because there's many other factors at play. There's other stimulus at play. There's, banks not having to repossess. There's handouts, all of this sort of stuff, right, coming in play. So that's where we are right now. However, so this was taken, I just sort of screen grabbed this. This is actually a few weeks old. 800,000 homeowners with fixed rate deals ending in the second half of 2023 with a further 1.6 million mortgages due to expire in 2024. Plus, of course, all the people hoping to buy their first home, some of whom currently cannot meet mortgage affordability tests, right? That is a huge amount of people. And I've been calling this the gap since I started this channel in March. I've been calling this the gap, the amount of people that are coming off the fixed rate debt. And as we have more people come off their cheap fixed rate debt, okay, and interest rates are there higher for longer, which the bank is saying they're not going to go anywhere quickly. So let's just get rid for the moment of that thought process of, interest rates are softening. We're seeing banks with 3 point whatever percent. Yes, but they've got 5% fees, 7% fees on it. It's making it all up. It's smoke and mirrors to con you into giving your business to them because they're fighting for customers. Right? The affordability is still being massively stretched by interest rates as they are, and that gap is getting bigger. So interest rates staying up where they are, more people coming off, right? As we go into 2024, this for me, right, is the inflection point where we are right now. We're going into that time where we're going to start rapidly seeing things unravel in terms of people coming off that cheap fixed rate debt, right? The own government statistics, and I've shown this a few times now, but I do want to stress it, are saying, and they're not even talking about 2024, right? If you look at this graph, they are showing how much things are going to go up in terms of cost, just mortgage costs between now and 26. So, of course, there'll be more people in 25 and 26, people on 5-year cheap fixed rates, all that sort of stuff. You've got here 1 million people by 2026 will be paying over £500 a month more just on their mortgage interest. That's just on their mortgage interest. That's before we look at all the other pieces of affordability. But it's fine because wage growth is strong, right? And we've tamed inflation. Inflation is gone. So it doesn't matter, all of this extra cost. Even though the UK ONS's own graphs are showing the debt service ratio of the UK going up and up and up right now, and they go, it's nothing like 2000 and 2008. Well, we haven't got to the top of it yet, right? We've still got years until we get to the top of this ascending debt service ratio for the UK as a whole, and this is before we take into the cost of everything else that's going up, right? Look how much our mortgage interest is spiking in terms of mortgage interest payments right now. Imagine what this looks like in 12 months' time, this graph. I've just realized I'm not on the iPad. So we're back on the iPad. Sorry about that, Tim. Just in case you didn't see the debt service ratio. This was the debt service ratio as we go up and up and up, right, into 2026. And yes, we're not at the same DSR as the height of the financial or 2006, 2007, but it's going up fairly quickly. Okay, and this is what we're paying in terms of our interest, net interest payments now. Imagine as this goes into 2024, if interest rates stay where they are, even if they just stay where they are without going up anymore, you know, millions of people coming off their sub 2% deals. And as I said, this is before we take into consideration affordability. Before we talk about affordability, and I'm going to go into where we're looking as we go into winter 23 into 24, okay, and how this is going to affect everything. And by the way, I've always said since I started this channel that winter 23 into 24, which is what we're about to go into, I feel is going to be the max pain. I feel people are going to be feeling the max pain, and I've said it for 2 years now. The first I started seeing it in my own units, my own HMOs, when I started seeing utilities going up at the end of 21, you could see, right, that we're going to get first bite of the cherry last in terms of crunch of affordability, people actually paying bills, all that sort of stuff last winter. But it's the second bite of the cherry, if inflation stays high and interest rates carry on going up, that's really going to start to hurt people into January, February 24. Before we look at that affordability, I'm going to give you a message. Team, I have a mission to grow this channel and help people empower people to take control of their financial futures. I'm just going to give you a quick message from myself about what you can do to help it, and then we'll be back in about 20, 30 seconds. For those of you who are regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better, and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income-producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Thanks, team. Don't forget to push that subscribe button. Please don't forget to do that. It helps us a lot reach the right people. Look, let's talk about affordability because we have already talked about interest rates. The gap into 2024. How many coming off their cheap fixed rate debt and going on to I don't care 0.9% with a set fee, right, or 5.5% with £1,000 fee. It's all mirrors. It's going to cost people a lot more. This is the current wholesale price of gas. You can see, okay, we were talking earlier about, I say earlier, like a few months ago, how that was coming down. We've now seen it go back up again, okay? So it's pretty much since summer of this year, wholesale gas has doubled again. Now, look, of course, we're not in silly season here where we were, but energy price cap going up in January. Not a huge amount, but it's going up. So we saw it come down. January is going to go up. Remember, when we talked about inflation last time, and all the narrative was about how much inflation has come down. Remember Hunt talking about it? Remember Sunak talking about it, hitting his claim, his pledge 1 month early? Nothing that they did, right, had any effect on bringing that inflation figure down. It was all because of utilities coming out, of the massive spike from last year dropping out of the figures, and the price cap coming down in October. That price cap will be going back up in January. Right, so that will feed back into the inflation data. Let's see what else we got. Remember, I always like to look at this 12-month trailing table in the inflation data. We've just had that massive 1.6% month on month on the CPIH drop out. It's actually 2% month on month on the CPI. So actually, let's talk about CPI, because they talk about CPI when you talk about headlines, right? And the pledge was to get CPI, not CPIH down, regardless of the fact that even the own data set says CPIH is the most accurate. Let's just work on the CPI. So over the next quarter for CPI, we've got a net plus 0.2% over the next 3 months, dropping out of the data set. It's nothing. If you look back 12 months, right, the next quarter is pretty much flat in terms of month-on-month growth. If our inflation starts coming up, and when I say coming up, even if we're sitting in 0.3, 0.4, 0.5% month-on-month, right, we're going to see inflation go secondary. We're going to see that little uptick in inflation over the next quarter, okay? And don't forget, please, everybody don't forget, because there was almost like celebrations and Mardi Gras when it came down last month. Inflation coming down from 6.8 or whatever it was to 4.6 does not mean things are getting cheaper. It means they're getting more expensive at a slower rate, and they're still almost 2.5 times over target. If we now get a little uptick, right, we're still seeing things getting more expensive. It's more, and that's compounding over a year beforehand. So, there was talk about food inflation dropping at its quickest rate. Well, it's gone from like 20% year on year to 10% year on year. It's still going up at 10%. I cannot believe the cost when I go in and shop, right? When you're just buying essentials and staples. And between me and my partner, we have 5 children, right? Imagine those shopping bills. And when you look at that inflation data, and I know I've covered this a lot, and I'm just kind of recapping at the moment, it's this line here, right? Yes, this is all coming down. This is the stuff that's totally out of our control, right? This is the utilities, this is gas, this is electricity. This dark line here, this is our owner-occupier housing costs. This is what people are actually paying, right? As well as food, but pretty much food and shelter are the things that people have to pay every single month to live, to pay their mortgage, to pay their rent. And look how stratospheric that is not peaking, right? We're hitting an elbow in a curve. That is going up and up and up, right? And this is going to carry on over the next couple of months. So people are not getting richer right now, regardless of what nominal wage growth is coming out. If we zoom in on this again, remember this is what the weird picture was for last month, because we saw this data set. That's the utilities drop out, but the rest of it, this is owner occupier costs. The green is rent. Okay, they're getting bigger every month, right? Our affordability is not going really in the right direction. And then you look at the budget, right? Let's look at what's coming to the budget. Woo! Some national insurance comes down. It's good news, right? It's going to make things more affordable for everybody. But no, because when you actually crunch through the figures, because of this stealth tax, which effectively freezing income tax brackets, which means as people's nominal wage growth goes up, mainly due to inflation, let's not talk about price wage spiral, but more people are going to be dragged into higher rate tax brackets. So more of that is going to be taken out of their pay packet from tax. Okay, so this fiscal drag concept comes in, where people are actually going to be worse off, and we're seeing the highest tax regime since the post-war period now is where we are. So all of these things are going in to crunch people's affordability more, and of course we'll have to see what happens to wage growth. Have I got a wage growth? I do have a wage growth chart here. This one down here, this is real wage growth. This is nominal. But there are definitely talks that the nominal has peaked. We do have a flattening off of that curve now. It's not going to carry on where it is forever. It cannot carry on where it is forever, because as the economy gets more frail, okay, if we start to go into recession, we're not going to carry on seeing wage growth at these sort of levels. And if we do, what's going to happen? It's going to keep feeding into the inflation figures. It's going to keep that inflation high, and it's going to keep those interest rates high for longer. And we get stuck in this vicious circle. So we're between a rock and a hard place right now. And let's talk about what else was in the autumn statement. Okay, effectively the second budget of the year. I actually think this is massive. As an employer myself, with quite a lot of people, I would say on lower income brackets. In the scaffolding business, we have drivers, we have labourers, so we have people on minimum wage. The increase in minimum wage is significant, and we are talking, I can't remember the figures off the top of my head, 15, I think in some cases for some age groups, 15 to 20% increase in that minimum wage hourly rate. That is a huge amount, because that does not just filter through to people on minimum wage. That ripples through the entire company, right? Because if the lowest paid workers, and I can tell you this because I know right now that next year when that happens, right, if the lowest paid workers get a 15 to 20% pay rise, everybody else will want a 15 to 20% pay rise. And if they don't get it, they will walk and they'll go to a competitor. Because we're still certainly in my industry, I know it's different to other industries, we're still in a very tight labour market. There's not enough skill out there in construction because nobody wants to, learn trades or be an apprentice these days. So that's going to filter through the whole workforce. And that has to then, we get the pass inflation, that has to go on to our top line. When we have to cater for that, right? So we're going to have to be putting our prices up. And to make our margins, we generally bill twice our labour. It's generally what we put our labour out. So everything goes up by 20%. Labour goes up by 20%. We're going to put our the doubling up by, effectively 20% as well. So it's double that. So it's quite a bit more to maintain margins. And if you don't maintain margins, then businesses are going to start failing. Okay. And, as I said, as a business owner who lives in this or works in this environment, that's a big thing for me to have that amount of, additional. And when you add it on to, pensions, all of that sort of stuff, there's lots of things that are eroding here, increasing corporation tax above 50,000, plenty of things that are making it more challenging. So it kind of brings me to the question, how long can QT, which is quantitative tightening, which is the phase we're in at the moment, last for? We're in a phase right now where QT, let's just put it into two things, right? So we've basically got high interest rates, and the Bank of England is selling off the bonds they bought from the government, right? So that's an interesting discussion which we won't get into too much, but let's just put it in really simple terms. QT is going to make things more difficult for the economy, right? It's putting QE, so for easing, it's pumping money into the economy. More money can go into the system. It gets businesses more, they can spend more. Everything grow, but it causes inflation. So to get rid of inflation, we're doing the reverse of that. How long can it last for? Because at some point, it's going to start breaking the economy, okay? And especially if we see things like the inability, if everything starts softening, inability to put those prices up as a business, but you've still got to pay those increases in labour rate, as an example. This was the divergence in retail sales volumes we talked about last week. Volume at the top, volume is at the bottom, this light one, value at the top. So people, basically what this means, people are spending more money on less stuff. So that's not a great position to be in. And we are just about limping along, somehow avoiding recession, but I can't see how that's going to go on forever. And then we look at our sovereign debt. And I saw, in fact, Brody, I think it's, I thought out the corner of my eye, I saw a comment from Brody talking about basically national debt issues. This QT program that we're doing, number one, with the interest rates higher, is causing massive additional serviceability or service payments of the interest for the government on all of their debt. So we can see here at the moment, where it's costing us $2.5 billion to service our debt. By 27-28, it's forecast to be $19.5 billion. But something that I keep talking about that I don't see anybody else talking about is the amount of losses that we are having to cover. When I say we, I mean the Treasury are having to cover on effectively the Bank of England's losses selling bonds at the hugely deflated value they are right now because of the higher yields, right? I'm not going to go into bond valuations inversely related to the yields, but let's just put it like this, right? Bank of England, as part of their QT program, are selling bonds off. Bonds are worth a lot less at the moment due to the yields on it, and there's a little clause from the QE cycle that we started in 2008 that says any losses are indemnified by UK Treasury. So effectively, right now we are spending billions, right? The Treasury is spending billions plugging this gap and protecting the Bank of England. This is now August. As I said, we're about to go into December. I'll be very interested to see what's been happening since here and how much money we are pumping into it. So I don't see where the UK the government's going to get all the money from right now. How do you service the debt? How do you cover these losses on QT? How long can QT carry on going for? How long can we keep taking money out of the system before the whole thing breaks? And if the whole thing is going to break, does that mean we have to go back to QE, right? Are we going to see a point where to help get out of this debt burden that we've got, we have to go and print money again? And this was the scenario 6 that somebody very kindly put in after my session last week, talked about, look, we could be here in this position where we have to, because things are so bad, we go into a deep recession, the housing market starts, because they're symbiotic, don't forget, everything's cyclical. Economy goes down, it's suddenly going to create forced sellers. Right now, we don't have the forced sellers, we're suddenly going to have those forced sellers. It all starts descending, right? And we have to reverse from QT to QE. You go to QE, you start pumping money in the system again. What happens? Inflation goes back up, right? And we're stuck in this horrible cycle. Inflation goes up, interest rates stay high. How do we fix this scenario? Yes, long term it's going to erode our debt away if you've got mortgages, but you're in this pretty horrible cycle. So, as we go into 2024, this is a scenario that could play out. I'm not putting figures on what could happen if we sort of end up in this scenario. It's certainly a lot more bearish than some of the other possibilities we talked about last week. It's hugely more bearish compared to, I would say, a lot of the mainstream points of view. I'm just going to find it quickly, if I can. The, the Savills report that came out, and they had They tried to make it very pictorial. Can I find it? Is that the one? I can't find it for some reason. I must have shuffled my slides up. But the Savills were talking about 2 to 3% drop next year, and then we're back into growth in 2025, which I think could feels a little bit optimistic. Let's see where we're going with interest rates then, okay, and see the impact, because when we went live last week or the week before, obviously Bank of England base rate had been held, inflation data came out and it was much lower than people thought, and there were these signs of the creaks happening in the economy, especially that retail sales index. And all of a sudden the market went, ooh, the bank is going to have to drop their rates much more quickly, which was completely at odds to what the bank said, which was, we are not going to be dropping our rates quickly. It's unlikely they're going to be going down in 2024. They're here to stay. And there's this term been coined, tabletop mountain, right, where it's gone up and it's going to stay tabletop mountain for quite a long time. The market disagreed. The market went, nope, they're going to come down. We're slashing our expectation, right? Yields fell, swap rates fell. So let's just see. This was 17th of November. So what's the date today? It's 27th now, so it's 10 days ago. So I was saying when we went live after this one, the 5-year was just touching on 4.094%. So for the first time, it was looking trajectory like it could dip below 4% on the 5-year fixed, Sonia, to sub 4%. And I was watching out for it. If we look at today, okay, we've now gone up again. Okay, so again, not a huge amount, 0.2%. And in my experience, the markets are very reactive, okay, very reactive. So they see a piece of information, they immediately just wade in and make their own predictions, right? And it's like that sort of overshoot, that euphoria, or however you want to term it, has kind of calmed down. And actually maybe the expectation is creeping back in again that, wait a minute, maybe they're not just going to be slashed real quick. Maybe we can't just do that and start lowering interest rates when you look at potential secondary inflation effects, et cetera, et cetera. So swaps have crept up again with 5-year fix at 4.217. And don't forget, this is where mortgage rates are set. So this is the market saying over the next 5 years, the interest rate will average 4.217%. That's their expectation. Over the next year, they reckon it's going to average 5.115%. So that's even the markets right now saying it's unlikely to be getting much below 5 over the next 12 months. Doesn't mean it can't be below that. It just means it's going to average it over the next 12 months. Okay, so that's where we are with the swap rates. And this is all before we talk about what's actually happened with real house prices. And I was doing an interesting piece of analysis this morning with real house prices against gold. So this is the from website priceandgold.com that I found. We have effectively got the gold index. That's this blue one here. Okay, this blue one at the bottom is how many bars of gold effectively do you need to go and buy a UK average house? And we peaked at about 2005. You can see we came down 2012 and we've been back up, but there's been a floor there. But we're pretty much exactly where we were in 1987. We're pretty much exactly where we were in 1974. So effectively, right, house prices haven't gone anywhere in terms of real value in the last 40 years, 50 years. They've gone up, they come back down again. And this is another interesting concept, and this is something that I feel quite strongly about as an investor, how you need to view house prices or how you need to view property as an investment. Because I still feel that people, when they're looking at property, they look at it as a store of value, a store of wealth. For me, it's not, right? For me, it actually is a liability. Because you have money, you've got to put it to keep it go for you. So your own home, right? It's my asset. It's an investment. It's gonna set me up for life. When you look at it in real terms, it's pretty much the same in terms of if you put your money in gold in the 70s, it'd be worth exactly the same as if you put your money in property in the 70s. Now, this is before we talk about leverage, of course. But the difference between gold is it sits there, maybe looking nice and shiny in a vault somewhere. Property in all that time, you probably had to put loads of money over 40 years, to keep it running, to maintain it. You're probably going to have a few kitchens you've gone through, a few bathrooms, redecoration, maybe a new roof. The actual headline price is fairly irrelevant when you look at property. For me, property is not a store of value, right? It's not an investment where you just stick it and get passive gains. Yes, that has happened in nominal, sort of terms. But for me, property is all about an income generator. Unless you're flipping, unless you're developing, that's different, right? If you're buying something, adding value, selling, like building new builds or buying something run down, doing it up and selling it. That's different. That's trading. That's not investing though. That's trading. If you're investing, it's all about cash flow. It's all about the income streams that property creates. It's all about the ability for you to add value, recycle your initial cash out, and then generate income streams on no initial capital, right? This is where we talk about return on capital employed, the ROCE figure. It's the only thing that I care about as a property investor. And when we do look at this, okay, and we look at the nationwide and where we are in terms of the long-term trend of inflation adjusted house prices, where it puts us down to about 2001 at the moment. It's probably still going to be going down. Property's looking cheap, right? Property is looking affordable right now. So I do think 2024 we're going to see more drops than the mainstream are forecasting. I do not think nominal we're going to get to the 35. I put 35 in because I know that's kind of the highest limit that the narrators are talking about in the YouTube sphere right now. I personally don't think we'll get there. We might do. It's a probability. I think it will be somewhere in the 15 to 20% range, peak to trough, in terms of nominal. Is my personal feel. But in real, it's looking affordable. And at some point, this will reverse, right? It won't be for the next couple of years, 2 or 3 years, but at some point it'll be a reverse. So I feel we're in an accumulation phase right now. Okay, because things move so slowly, we can accumulate for the next 2-3 years before we get that real term value start to go up again. Because it will. Look, went up massively there. It did go up there, and it will happen. So 2024 could get ugly. I think 15 to 20% is kind of where I am. Perfect. Right, that's what I've got for you. Oh, no, don't want that. Sorry, wrong button. Steady, Rob, steady. That's what I've got for you this evening. Any thoughts, comments, or questions on that? I will go through the comments and put a few in. Plymouth, interesting. So Tall Rhythm Golf is in Plymouth. Let's put that onto the broadcast. Stuff coming on at near peak prices and sitting there. This is what I mean. If people don't have to sell, you're just going to chance your arm. You're going to put it on at the price you want to sell it at. And if it doesn't sell, it's like, who cares, right? I'm on cheap fixed rate debt. I don't mind. I'm happy to hold this. So I don't know why people are bothering to do that. They're hoping that some silly person is going to come along and, value it wrong, I guess, and buy. So, yeah, there we go. I think we've covered that enough. Let's get some questions, if we've got some questions. Brody said, see 2024 bringing in a liquidity crisis. Yes, I agree. Brody says you've been uploading gold. I think you put that comment in before we actually talked about gold. So there we go. Any other questions? Well, the Tories would be quite pleased to lose. Yeah, this is an interesting one. Stafford, Tories would probably be quite pleased to lose the next elections. The pot will be truly empty. I think it's really interesting. There's been a lot of discussion, I would say, since the budget, talking about actually, are we going into an age of austerity? And of course, they're like, no, we're in growth. They're looking at, where can we cut taxes? But this is where you need to look, under the figures. Yes, a headline national insurance rate is good news, but the fiscal drag completely offsets it by a lot. Taxes, I cannot see them being cut anytime soon, because you've got this debt burden, right? And with interest rates high and the QT in process, how long, they need to cover this debt burden from somewhere. You can't just be getting rid of. Interestingly, they have talked about quite a change up in benefit, haven't they? Welfare reform. So we'll see what goes on that. Lovely. Sorry, I need to work out how to take that off again. Remove. There we go. I haven't got my glasses on, so I can't see. Stafford, in the meantime, depending on how the next tranche remortgages go with affordability and the year is up for repos, we'll see whether house prices go slow or fast. Yeah. I think it'll be interesting when the banks do start repossessing. If anybody's new and they haven't seen it, let me just put the current arrears data on for you. I definitely have that slide in the deck somewhere. I'll just try and dig it out. There it is. So this is the current arrears data. It's not cataclysmic for residential yet. I say not cataclysmic. We're still 36% up year on. This is for residential, so let's exclude buy-to-let for the moment. 36% year on year, 10% quarter on quarter. Don't forget, this is people going into the bracket of 2.5% to 5% of a mortgage balance. And that's important. It doesn't mean those are the people who are not, this is all the people in arrears. I'll be really interested to see anybody in arrears, how that's going up. Because if you've just taken out a mortgage, you've got a 25-year repayment mortgage, you're going to have to miss 5.5 months of interest payments before you go into the 2.5% bracket. I worked it out. 5.5 months is quite a long way in. So as we go into next year, Q1, Q2, I think we're going to continue to see this going up. And it's going to start maybe to look a bit more like the buy-to-let one. Okay, and I mean, this is now seriously big figures on the arrears. So that's year on year 174% and quarter on quarter 33%. So that's going up a third a quarter now. That's a lot. And if you look at that line, that is just visually now, sort of inflecting quite quickly. So the buy-to-let sector is in real trouble, because the majority, and I say this I want to say this in the nicest of ways, the majority of retail investors invest in buy-to-let by just getting a deposit, buying a property, not particularly doing anything to add value to it, and therefore the rent roll they're getting from that property has probably been pretty much washing its face, or paying the mortgage with the low debt. Because a lot of people buy it, think it's going to be that store, and in 10 years' time, 20 years' time, it's going to, be a massively more valuable. And in normal terms, they might be right. But spend X amount, tens of thousands, hundreds of thousands over that time period, maintaining it, looking after it, paying the interest on the mortgage. And in terms of real value, it might not have gone up at all. It might have gone down quite considerably compared to something like gold, for example. That is, I would say, retail property investing. That's not the same as what I consider professional property investing, which is, and by the way, we have like a 3-step. In fact, good time to talk about it. That's a nice segue in. If anybody is looking to be able to invest like a professional, and in the current environment, there are 2 things you need to focus on. You need to be able to add value or force value appreciation, because the days of passive capital gains are over for years, I would suggest. So you have to be able to force value increase, because we need to increase the value when we buy something to be able to recycle our funds out, remove our initial capital, which means we then got equity that we've created out of thin air in a property, right? De-risks it for us, and any money we do leave in a property, we're then going to get a massively high return on it. Now, of course, you're probably saying, but if we leverage and take all that money out and highly leverage, then the interest is going to kill it, right? So we're not going to be able to have cash flow because of the interest or the debt servicing. Well, this is where we need to do the second thing, which is to be able to operate high cash flowing models. So higher density units, higher value rents, short-term lets. There's a whole host of things we can do to increase the cash flow on the same footprint, of a building. So we need to combine those 2 things together, because when we do that, we create a very high ROCE, return on capital employed. If you're looking at what strategies are working right now to do that, I've got a white paper. Please feel free to download it. It's an ebook. It's free. It'll probably take you 30 to 40 minutes to read, and it goes through the sort of 3-step system that I use, the AAA method. So please have a look at that and let me know what you think. But yes, going back onto. Oh, by the way, sorry. If you want to download it, there is a link to that. Just before I forget, if you don't want to type it in, there is a link to it in the description of the video, and I can always link it in a pinned comment as well if you want to grab that. So yes, normal buy-to-let, traditional buy-to-let is in trouble. The other thing that's in trouble, actually, and it doesn't show it on this because this is resi buy-to-let, is commercial. Commercial is horrifically in trouble. For the last 18 months, 40% down in terms of values, probably still going down with the yields being high. Commercial property really struggling in terms of evaluation, just like bonds, they're valued in the same way. So there's a massive opportunity there with commercial as well. If that's something you are interested in. Cool, perfect. Let's see. Oh, we've got a question from Urban Achiever. Let me put in. How do you see recent wage growth affecting house prices? It's a very good question, and without a doubt, it has a factor. And for me, there are these mix of factors, right? And you've got your push, you've got your pull, you've got your contradictory factors that are, pulling markets in multiple directions. There is not one factor that will make, unless it's a external black swan event like the credit crunch, right? You look at 2008, that was a boom, credit crunch, banks stopped lending, it's all pulled. That's a one-off factor that completely, changed the course of the property market there. Different to where we are now. because we have these conflicting factors. And yes, we do have strong wage growth. Interestingly, I did a piece of analysis a couple of months ago and looked at the difference between if you're at the rate of nominal wage growth, the increase in your income for an average salary versus the average house price debt serviceability on current interest rates. And this is what I mean about leverage works both ways. If you've leveraged to buy a property and you've got a big mortgage on it, then if your wages go, let's just keep it easy, let's say 5%, right? And you're earning £30,000 a year and it goes up 5%. Your increase is going to be $1,500. You're going to get £1,500 extra a year. If your interests go up 5%, and let's say you've got let's try and keep this super simple, a £300,000 mortgage, okay, and you're paying, let's just say, I don't know, I'm trying to do some public maths here. Let's say you're now paying 5% a month versus 2.5% a month. A year on it. Let's just work that out. 300 grand, 5% is 15. 2.5% is 7.5. So we've got a 7.5%, a £7,500 increase in terms of your annual interest from a 2.5% to 5% jump versus your £1,500. Now, I've probably gone slightly higher. The average house price won't have a 300 grand mortgage. I'm going to probably be more likely to something. But you see what I mean? Because you've leveraged. Leverage works both ways. It means you can stretch your money further, but it also means when the serviceability goes up, right, that debt serviceability is going to be more expensive for you. So actually, the one in terms of servicing your additional interest is much more potentially on an average basis than your wage growth going on. However, it is going to cushion it. So it's better than losing nominal wage growth. So that is a factor that has cushioned things a little bit and means there's that, it's not contributing so much to forced sellers. If we've now seen that peak, right, and that wage growth is now starting to drop off, and we'll have to see what happens over the next few months, and the economy starts to break and we start to go into a recession, right, that's going to drop off more, and it's eventually going to drop off to zero when people become unemployed, right? So average wage growth is just like average house price. It doesn't mean that everybody in the country is having a 10% or 8% or whatever it is a year, wage hike. There's going to be lots of people losing their jobs if we go into recession, and all of a sudden their wages go to zero, right? So that's going to have a big factor. So that was a very long answer to a very short question. Yes, a factor is cushioning it for now a little bit. I don't believe it's as big a factor as the lack of affordability with the interest rates going up. Hopefully that makes sense. Cool. Oh, Stafford, how about paying cash for a rental property? Reasonable investment. Stafford, here is my view on paying cash for a rental property. Yes, but do not leave in cash. So I very much operate a cash in, mortgage out methodology. The reason I like to buy cash is much more powerful to buy. It's not difficult. It's very difficult to get really good property deals if you can't move quickly. Very often, the ability to buy things at a significant discount to what they're worth would be your ability to move quickly. So having cash gives you that ability. You could say bridging does that as well, but bridging is extremely expensive, especially in the higher interest rate environment. So your margin is going to be eroded. So what you save in buying it cheap can be offset by the bridging costs. So cash, you don't have to worry about that. Of course, cash is going to be safer. But it's also going to mean if you just leave it in cash, you're going to be getting a much lower return. And here's the issue. If you're in cash, if you stick it in cash, and let's say the market does go 20% down, okay, that's your cash being eroded at that point. So you're really slicing off your nest egg. If you buy thing in cash, force pressure, recycle your cash out of it, you're okay, right? You can go into another pot, you can do something else with it. And if you're then getting income streams which are servicing that debt and giving you an income, brilliant. Now, the only issue, with that as a concept is if we are in, I would say, a rapidly falling market, and I would say probably potentially more if you're in the commercial space rather than the residential space, is your lending is going to have loan to value covenants. So effectively, you're going to get to a stage where, I don't know, let's say you buy it for 100,000, right, in cash. No, let's say you buy it for 50 grand in cash. Let's go really super crazy figures. 50,000 in cash. You put 20 grand of works into it, so you put 70 grand in, and then it's worth 100 grand. Okay, and you get a 75% loan to value mortgage on it, so you pull out 75,000. So you get that 75 grand back. Now, I know that means you're pulling out more than you put in. Let's just assume you can do that in the current market. It's going to be tricky, but let's just assume you can, right? So you put all your money out and another 5%. Awesome. You've now got all your money out. Anything that comes out is now effectively infinite yield on that property because you haven't got any of your original money in. However, you're probably going to have a loan to value covenant on that the mortgage company will say if it drops below a certain debt serviceability or a certain loan to value, we can come in and repossess it. And if you go back into 2008, that's effectively what was happening with a lot of commercial property, in that the values dropped so considerably. And actually, I believe for institutional commercial real estate investors, that was happening somewhat in sort of post-COVID, where the value of, we had a boom effectively in, well, not boom. Let's just go exactly post-COVID. You probably say there's a massive initial drop in terms of value because everybody came out of offices, certain types of commercial that were really affected by COVID because people just couldn't go into work, right? So values dropped, loan to value covenants were broken, but the banks were very sort of understanding with this. They didn't just go in and start repossessing, whereas in 2008 they did quite aggressively. So that's the only thing that you can I would say get in trouble with if you got what you're going cash out. Does it matter that much? But yes, if they repossess for loan to value covenant, you don't want that to be happening. Just so everybody who is on the live stream knows, and I'm going to wrap it up after this. I'm accumulating right now, so we're investing. We have our second investment of the year going through legals right now. That will be 1.4 million pounds worth of acquisitions this year in the Northwest over two particular deals with significant amount of forced value appreciation in those, but they're very much cash flow plays. So if the average values do drop 10, 15, 20% in terms of the UK average values, I don't really care about this because we bought them at a price because they're valued on a commercial value basis. We bought them very cheap bricks and mortar. And then because they are valued as a percentage of their income, the actual value will be much higher, which means you've got a lot of forced value appreciation in there. So all these averages just don't really matter at all in terms of the average UK property. It doesn't matter, right? Because we bought something very cheap, forced appreciation, cash flowing nicely. We don't over leverage at the moment, certainly being very conservative in loan to values to make sure you don't fall into that trap of not being able to service the debt in case something else happens, call it oxygen tanks, all that sort of stuff. But at some point, interest rates will come down. And then at that point, we can probably, sort of leverage a little bit more if you need to release some equity in the future. Hopefully that answers the question. All right, team, that's been good. I've enjoyed that this evening. Hope that's been good. As always, give me a thumbs up if there's some value in that for you today. Please do not forget, look, I would appreciate it so much if you could help continue to grow the channel. We're getting a great following. It's great to see the same people on every time and getting into the conversation. I'm going to be looking at doing some property trainings on here if that is something that people are interested in. But please don't forget to like, subscribe, carry on growing the channel so we can cut through all that BS, right? All that mainstream nonsense that goes on, because now is a great opportunity for those who know how to do it, have the skill set and the mindset, right? The opportunity is there. And if you don't care about investing in property and just interested in the market, it's great to have you on board as well. And I hope you get some value from these sessions. Right, I'm going to tick off for the evening. It's almost the end of November, so we'll be into December's cycle of house price indices. It'd be interesting to see what's going on with Nationwide, which will probably be released Thursday. But I'm up north in Chester, so I probably won't be able to go live until next week again. Have a good week, everybody, and I'll see you on the next one.